Have you ever wondered if there's an easier way to consistently make money in the stock market? After making thousands of investments over the past decade, I discovered one thing that changes everything. It's what separates the investors who consistently grow their wealth from those who watch their portfolios slowly bleed out. To help make your investing journey 10 times easier, here are 4 quick fire lessons I learned that help you do just that. Take your portfolio from inconsistency to consistency. Now, to understand why most investors lose money, let's answer this question. Why do you stay in a bad investment longer than you should? Speaking from experience, it's because you'll hope that it will turn around. I found it really frustrating because I'd see other stocks move up, and I also did not like that feeling of the time passing by with nothing to show for it. Days turning into weeks, into months, and still no idea of how to pick good stocks. Now, compare that to a winning stock. When most people see a profit, they cash out way too early, fearing it might drop. And I've been there too. That sense of relief making a profit when nothing before that worked out. Got to bank that ASAP. But once I got over looking at that winning stock in isolation and focused back on the bigger picture, I still had nothing to show for it. A winning stock swamped in a sea of losing stocks. Tiny profit lost in a dark cloud of losses. Now, instead of letting losers run and cutting winners short, which clearly is wrong, I needed a strategy that lets winners run and losses are, well, just insignificant. So I went back to the drawing board. No more trading for now and more studying. Time to get studious, because when I decide to do something, I like to do it properly, figure out what the best practices are and make them my own. As we move on, I'm going to show you precisely how I nourished the investor in me, eventually leading to an audited track record that got my Luxembourg-based hedge fund approved with a track record of over 30% per annum. So why do investors struggle? Simply because they don't follow a structured process. Now stay with me on this. They let emotions, news headlines, and random stock tips dictate their decisions, precisely to a T in what I was doing. But investing doesn't have to be, and actually mustn't be, a guessing game. There's a timeless code, a proven system, a way to stack the odds in your favor for each and every single position you take, each and every time without fail. So let's break down the key 4 quickfire lessons that you do have in you to polish off and make your own. But be warned here, guys, this is the point of no return. After this video, you will have a choice to make. Go back to what you were doing before and settle for inconsistency, or upgrade and clean up. Still with me? Okay, great, let's move on. So lesson number 1, you need a proven framework for choosing stocks that actually make you money. Logical, right? Yes, but how do you do that? Most people throw their money at stocks hoping they'll go up. I used to do this with stocks that were being hyped up online, or I bought into the narrative that it is a company I like or buy from that make good investments. Listen, that is up there when it comes to trash advice that is taken as the status quo. We absolutely do not do that. If you want to double your expenditure by buying from a company that you like and combine it with the losses on their stock, absolutely follow that advice. But if you want to spend money freely on the companies that you like and have that spending absorbed into large compounded growth from your stock investments, then this is what you must do. First, we scan the market, filter for the strongest stocks using our proprietary tools, and only focus on the stocks that present an edge, which, if we're going to get geeky about it, and we must, means identifying high probability stocks. And that means establishing stocks that have more chance of making a profit than a loss. But here's what people miss. That profit must be made over a sustained period of time, not seconds or minutes or hours. We are talking weeks, months, even years, where the big money is made. Because if you're going to do this, why think small? It helps absolutely no one. So how does a stock with an edge actually look. If we want the biggest moves, it makes sense then that the high probability stock is one that aligns across the monthly, the weekly, and the daily timeframes. This means that the stock is moving up on all three timeframes. The biggest, most profitable trends happen when momentum aligns across these higher timeframes. If a stock isn't showing strength across all three, we simply do not touch it. But what exactly are we looking for? Well, picture this. Let's say you're considering investing in a stock. You've done your research, however that may look, and you're ready to pull the proverbial trigger. But before you get trigger happy, ask yourself this. Does this stock have a history of sustained long-term uptrends? Or is it the type of stock that pumps for a few months and then crashes back down? This is why history matters. Stocks that have consistently moved up over years tend to keep doing so. And stocks that have spent most of their history chopping sideways or declining, well, they tend to do more of the same. So the second key lesson, history doesn't repeat, but it sure does rhyme. What has happened in the past is a very good indication of what is likely to happen in the future. If a stock has a long history, one of many, many years of performing well for its investors, it is very likely to repeat this in the future. The opposite, though, is also true. Poor performing stocks will continue to perform poorly until they prove otherwise. So if you're constantly chasing hype stocks or meme stocks that do not perform well, you're playing a losing game. Or if you're constantly trying to catch the top of a rising market, which we see all over social media, then you are ignoring history and letting ego guide your decisions with ultimately disastrous consequences. One of the first rules of good investing is to ignore opinions, including your own. They have a very, very long history of getting people on the wrong side of the market. Instead, you want to align with the bull market, particularly with top performing stocks that have a proven history of sustained uptrends. And here's the truth, most traders, particularly the ones fixated on day trading and those elusive quick wins, simply don't want to hear. You do not need to trade every day to make serious money in the stock market. In fact, trading less often but with higher quality stock picks has a long history of being significantly more profitable in the long run, as it has the benefit of compounding. Most retail traders lose money because they've ultimately chosen a life and in many cases been sold a life in front of their screens, reacting to every little price movement. They're trying to day trade their way to riches, but the reality is that virtually all day traders fail. So, lesson number 3, adopt a long-term mindset. Stop treating investing like a get-rich-quick scheme. It has a very real potential to go bad very quickly. So you must prioritize protecting your money over making money. This fundamental shift in mindset unlocks vast riches, but it just takes a little bit of time to get there. And so it should. You have to earn your stripes, and the rewards grow exponentially, not just from a money perspective, but also from a character building perspective. Now, look, I get it. I know what you're thinking. If it were that simple, everyone would be doing it and doing it well. The truth is that everyone has the potential to be a very accomplished investor. If I can do it and my business partner can do it, so can you. But few make the right choices. Most budding investors know they should focus on long-term trends. It's obvious, particularly when short-term trading just delivers loss after loss after loss. But they let hope, greed, and fear take over. It's all very emotionally driven. Take profit in fear as soon as a stock dips, or they chase hype stocks hoping for overnight riches. I get it. I've been there, but I learned that a systematic, rules-based system is everything. One that has a proven history of performance, so you do not need to waste time figuring this all out. Instead, you just need to learn the mechanics of what a good investment strategy is and run with it. Do not reinvent the wheel. You just need to learn how the wheel works and get it working for you. So let me break it down. Scan the market, identify stocks showing strong momentum, filter for quality. Only consider stocks that align across the monthly, the weekly, and the daily timeframes. Assess historical trends. Ensure the stock has a track record of sustained growth. Follow a rules-based strategy. Remove emotions and stick to the process. This is precisely how we find high probability investments that compound wealth over time. Now, you might be wondering what happens when a stock starts moving against you. Here's where most investors go wrong. They hold on to losing stocks for too long and sell their winners too soon. They have the process back to front. So, lesson number 4, reverse the process. Cut losers short and let winners run. Logical, right? The worst thing you can do is hope a losing investment will recover. Hope isn't a strategy. We exit stocks that no longer meet our criteria and ride the ones that do, regardless of brand name. As a stock rises, its movement consists of both upward and downward periods, yet it continues to trend higher over the long term. We use a wide stop loss strategy to avoid being stopped out by normal market volatility during a trend, giving the stock price plenty of space to move up over weeks, months, even years. If a stock reverses and hits a wide stop loss, it has clearly failed. This strategy is objective. It is a great way to exit stocks, removing emotions from the process and letting winners run if they continue to push up and come nowhere near the exit strategy levels. This is what differentiates successful investors from those who never seem to make money in the market. Look, I get it. Cutting out of losers is annoying, maybe even painful. I got over this by risking small, typically 1%, and using automated processes to cut out of losing stocks. So I had no attachment to any single position. And again, regardless of the brand name. Losses are part and parcel of the process. You must expect them and embrace them. If you can't stomach losses, this simply isn't for you. The goal of any good investor is to keep losses to a minimum and winners exponentially larger so losses become insignificant. And also get that letting a winning stock run can feel uncomfortable, as your natural tendency is to bank profit in fear of losing it. I've been there and done that too, but here's what I learned. Your biggest gains will come from a handful of stocks that you allow to continue to run, push up, and ultimately compound. Think about the most successful investors of all time. People like Richard Dennis, William Eckhart, Warren Buffett. They all say the same thing. The best stocks in your portfolio will carry the bulk of your returns. So if you want to be a consistently profitable investor, you must learn to sit tight on your winners and ditch the losers without hesitation. Many investors make common mistakes that prevent them from being profitable, and 99% of them make these mistakes daily. Watch this video to learn what these mistakes are and how to fix them so you can work towards consistent profitability.